Hey guys, let's talk about some important things. I'm going to go over one or two trades with you today on Roku, and just some important concepts relating also to options trading and how I keep getting hit with things like this and how you should prevent yourself from getting hit with them as well. All right. Now, obviously, I would have prevented all of these things if I would have just been trading with shares. But since I'm trading with options, it's more complicated because there are more factors that come into play when options are involved, because options also change their price based on volatility. Now, let me tell you how that makes a difference because, look, first thing, I traded Roku short as a put. When I saw the extreme panic sell below 140.250, I was short. And then I covered around here. All right, and then I waited for it to bottom. When I finally saw it bottoming out, one of my strategies is I like to buy after panic sells. After a giant panic sell like this, most likely we'll get a decent move in the other direction. So I look to buy now. So let's look at when I bought my first call. I went to go long via calls, and you can see here 155 call. I bought it at 9:50 a.m. for a price of 156. Got it 950 on Roku today. 950, where was Roku trading? It was trading here on this candle right here. So I bought here and my stop would have been below 130, would have been about 138 would have been my stop. Let's see here, 139. Yeah, my stop would have been 138. 1 point below, that was my stop. Okay, so I didn't get stopped out on this break below, and then we got this and then the move higher. So I got in here on this candle. So if I would have traded shares, my average price would have been 139.15 approximately. All right, so we got another nice move up. Now take this into consideration. Okay, I did not sell on this move up. I did not sell here all the way through here. I held it almost all day until I finally got stopped out near the end of the day. When Roku traded at 140.73, do you know what the high of that option was? Let's take a look. It was at what time? Hold on. It was at 12 p.m. At 12 p.m., that option was, in fact, trading in the 140s. And I think it might have topped out around my break even. So imagine that I bought it here, but the Roku price was trading higher than where I bought the call option, but my call was at break even. Tell me how that makes sense. I'll tell you how. It's pretty annoying, but this is it. It's because volatility dropped off in the market. After a giant spike in volatility, we do not want to be buying options because even if you're right on the direction, you're going to get hit with the drop in volatility if there's a drop in volatility. We do know that after large price moves, the most likely scenario if we bottom out is to just tighten up and just form tightening ranges. And that's exactly what happened. It's price discovery. We come down, form a high, then a higher low, lower high, higher low, and just tighten up until we get a break at that tightening range. And that right there is the drop in volatility. So being long calls or long any options, long puts or long calls, you will get hit with that drop in volatility. So that is why when Roku was trading up here or in this range above 140, I bought in when it was at 139. I should have been profitable, right? But wrong because I got hit with a drop in volatility. Also, there's some time decay on the option. So not only did I get hit with about 2 hours of time decay, which was not much, I'll be honest with you, but I got hit with that drop in volatility. And that is the number one thing. So how can you have avoided that? Well, you needed to be short options instead of long options. So the proper play would have been trade the put in the morning like I did on the breakdown and then wait for the bottom. And I wanted to buy the panic sell. And the most likely scenario after large panic sells, large panic moves, or even the opposite direction, is drops in volatility. So we want to profit from a drop in volatility. So we want to be short puts, or we want to be a credit spread, for example. So I would have been better off here, instead of buying a long call, just shorting a credit spread, or even a short put if I had the capital to just be short a put. And that would have been it. And I would have been laughing at that point. But instead I took the long call and I got hit with the drop in volatility. So that's it, guys. I hope you learned something from this video. Options trading is very technical and it requires you to be aware of all the factors that affect the price of your option. All right. next video.